Joining us now at Post 9 is Oppenheimer's Jason Helfstein. He's got a $515 price target and continues to have it a buy rating. You know, the question I've been getting, Jason, and I want you to answer it is, well, why didn't revenues move substantially if they added so many subs?
I think they're slow rolling the paid sharing rollout in the U.S., particularly for premium subs. So I don't know about you, but I've got 2 people on my account who don't live with me. I've got the premium plan. I have not been asked to pay more for them yet. And so they didn't tell Wall Street that. And they alluded to in the kind of call back last night that there's a whole lot of factors on what trigger the kind of paid sharing. It has to do with usage. Are you on your television? Is it mobile? Think about all the college kids that are home right now. And if they're the additional additional users, you're going to hit them in September. So they probably should have told Wall Street that don't expect ARPU or ARM, as they call it, to go up sequentially. It's more later in the year.
Right. But the 5.9 million was a decent number.
Correct. That was clearly a beat, a few million better than they expected. They're telling us it's going to be the same in the third quarter, plus or minus 1 or 2 million. So you're talking about 6 million subs, another 6 million. We have 7 million in the fourth quarter. So that puts you about 21 million new subs this year. And 25 million subs is our estimate for next year. The big question is, when does revenue per sub go up?
I mean, you're not going to, I don't know what you're going to pay for a company that's growing revenues maybe 3%, which is what they put up this quarter. I mean,
Sure.
That's not going to work. So,
well, we think you exit the year probably closer to 10%, and they do 18% next year. So the key is next year, if revenue per sub is up 8%, then you're looking at potentially, call it a 30% earnings growth, because they basically said content costs in 2024 will be flat with 22. Why are they saying that? Basically, with the strike, they're now saying content costs will probably end up being down in the back half of this year, right? And so they're like, it'll be down, margins will be better, but factor in that they'll go back to kind of normal content spending.
What's that number, by the way, these days?
Kind of around $10 billion. It's a big number.
Yeah.
The content spent.
Yeah.
But is that a good thing or a bad thing for investors? Because, yes, it increases free cash flow and helps profitability, but Netflix needs to keep the hits coming to keep those subscribers engaged.
Correct. Remember, Netflix is probably in the most unique position amongst all the streaming companies. So, yes, streaming does produce way earlier because of binge watching, right? They finish the show. It's not produced in real time like typically linear network television is. But all the international content isn't impacted. And I don't know about you, but, we're trained now on Netflix to watch international shows with subtitles and dubbing.
I've gone deep on Danish TV. Have you?
No.
Borgen. It's like
really?
It's the West Wing of Denmark. I highly recommend it.
Okay. West
Has
Wing of
an
Denmark.
even more likable central character.
So that's probably another reason why they're waiting to push on the paid sharing. So think about it. Back to school happens. People turn on the TVs mid-September. If there are no new shows, ABC, CBS, NBC, Fox, you're going to get consumers saying, why am I paying for cable when they're going to Netflix? And then we can talk about the advertising.
Well, I want to talk about the advertising because, the idea, these subscribers who are either new or being pushed to subscribe beyond their current plan seem to be going to the ad tier. But have they monetized on that front yet?
No. They've said there's a few percentage points right now of ad subscribers. Remember, the television advertising season runs from September to May, right? The fact is, even if they had more ad-based users, you're not going to get the money from advertisers, right? Right now, this is the upfront season. Typically, you negotiate now, and you get a handshake in typically early August on how much money you can get. So that money wouldn't even really be available in September. So they're typically in internet. You're being forced to kind of guess. I got to pay a high multiple and guess what happens around the corner. Netflix is literally laid out for you the next 18 months of how revenue accelerates, right? This pushing paid sharing to the premium subscribers who are not paying yet. Then we start to see advertising in the fourth quarter, the first quarter. Then you start to see they're canceling the low. Right now, you can't get the basic plan anymore in the U.S. or Canada. But that's only for new subscribers, not existing subscribers. So that will take time to kind of flow through. So you literally have 3 or 4 catalysts that play out, whereas you're just, as an investor, you're not taking a ton of risk as you look out over the next 2 years.
Felt like they were